Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly update with our friend Martin North from Digital Finance Analytics. How you going, Martin?
Pretty good. How are you going?
Very good, thank you, and thanks for joining us. Another super interesting month, and it seems that there's a bit of a recovery. We'll dive into all those numbers, but there's also been a range of measures now by government and so on, hasn't there?
Yeah, so essentially the kitchen sink is now being thrown by the government and by the regulators to try and get debt going again. Because, of course, we know at the moment that essentially it's debt and the functioning of debt in the economy that creates the growth. If you turn debt down or off, essentially the economy collapses. And so they're trying to use essentially the growth of debt to stoke the economy, but with consequences.
Yeah, and we want to give people the most accurate information, which we'll dive into. We don't just want to stand here and say the housing market's going to collapse, and I think these
Right.
measures are going to cause some subtle changes. So let's get into it. Or do you have any other messages before we do jump into that?
Well, just congratulations to you on the 50K. That's tremendous news. And it's very important to say, as you underscore, we need balance in the conversation, right? So essentially, we've got on one side of the fence, it's all gloom and doom, but everything's crashing. On the other side of the fence, property market's in full recovery mode. What we will need to do is to navigate through that middle path to say, well, let's look at the data. Let's understand what is actually being said at the moment and draw some conclusions from that, which is precisely what we're going to do.
Yeah, thanks, Martin. And I guess lots of people flocking to your channel and my channel, which means Australians are interested in all this stuff. So let's just flick back there to the first one. And we've got mortgage stress, which is continuing to rise, which is maybe something that I would have suspected was maybe slowing or turning down.
No, well, of course, this is up until the end of June or early July. And so far, the rate cuts really haven't come through in terms of any savings. And of course, the tax breaks, tax returns, the amendment to the tax system won't really come through. So people are not feeling any great change in their financial circumstances. On the other hand, incomes are still very flat, not growing in real terms, and the cost of living keep rising. And the most mortgages, they are still very big. And you put that together, we've got 32% of households now. That's the highest it's ever been. And I just sort of also added on this chart the post what I did with John Adams on Mandurah over in Western Australia, because we detected a couple of years ago that was a very high-stressed postcode.
Yes.
And we went back to there and had a look over the last couple of weeks. And now we're seeing the social consequences of that high debt, high stress, negative equity. So the point I want to make is mortgage stress is not an academic argument, right? What it shows is there are social consequences when people are struggling with their finances and with their mortgages. And it takes a long time, 2 or 3 years, but ultimately it does lead to social issues and broader, issues in the economy there, because Mandurah is looking pretty sick at the moment.
So, Martin, with that data that you collect and whatnot, how quickly would we expect to see that change if it is helping households?
Yeah, so I think that the next couple of months, we would expect to see some relief for some households. So, my expectation would be mortgage stress may ease down a little, because the 2 rate cuts will be translated into lower repayments for some households, not if you've got a fixed mortgage. Many are refinancing. So some of the activity in the mortgage market at the moment, which we'll touch on later, is refinancing of existing loans to lower interest rates. That will have an impact. But the tax savings that are coming through, the interesting question there is, will people spend it, or will they actually pay down their mortgages? Certainly in my surveys, quite a few people are saying, well, it's a relatively small amount, but I'm probably going to either save it or I'm going to put it into my mortgage rather than actually spend it. So we may not see an economic bounce from the tax changes that were legislated a couple of weeks ago.
Yeah, and that was one of the things that I was very supportive of back in the GFC. But I think we're in a different sort of place now. And I speak to a few different friends, and a lot of them say, yeah, I'm just going to pay down a bit of my credit card or whatnot rather than go out and spend it, as you say.
Yeah, and I think that if you move to the next slide, that's where we get to the confidence question, right? So the sort of the natural argument is when interest rates go down, it might be a little easier for households, but they are interpreting this as a sign of weakness in the economy. There's no doubt about that. And so the index, the confidence index, which I published yesterday, showed that there was a very little uptick after the election. But now with 2 rate cuts, essentially confidence is coming off again, and it's across the board. So people actually look beyond the headline news of interest rate cuts and are questioning what's really going on with the economy here, right? And the fact that the Reserve Bank has gone from emergency interest rates to ultra emergency rates, right? We've got to the point where we've got rates lower than they've ever been. People are recognizing that there's a reason why we're doing this, and it's not good news.
Yeah, and people wake up each morning and there's things, on Sunrise about how you should spend your money and all that sort of thing. And people start to say, well, hold on, why are we talking about all this stuff all of a sudden? And have you got any data around how much an average mortgage that person is going to be freed up with their payments per month or stuff like that?
Well, it varies on the mortgage, of course. But yeah, I'm sort of looking at maybe $40, $50 a month would be perhaps a typical average. It varies quite a lot across the country. But, it's enough to notice. But it's not a huge amount, right? Yep. If you put all of this together, it's not going to suddenly change the fundamental footprint of an individual household. It's not going to suddenly say to them, whoopee, I'm really rich and I'm going to go and buy a flat screen TV or two or what. It's not enough to really have that sort of. And just to give you a quantum, the GFC stimulus, if you add it all up, was about 7 or 8 times the amount that's currently in the system this time around. So it's nothing like the same as it was last time.
Yeah, so I was going to say, with this amount of cuts, let's call it $50. During a recession, they typically cut, say, 5%. That might free up $500 a month, which is a big impact for a family.
Sure. Yeah. Well, we'll see. Again, the household surveys data that comes in every week, we ask questions about their plans with regard to spending. And whilst people are a little bit more positive on house price movements ahead, in terms of their appetite to spend, there's no evidence yet coming through of any increased appetite to spend.
Interesting. Okay, so the problem is debt-driven. This is something we've spoken about a fair bit, and that household debt to income, new record highs again, Martin?
Yeah, so this is latest data from the RBA. It's actually to March. And once again, total debt in the system is as high as it's ever been. So it's a new record. Household debt for mortgages is also as high as ever. And owner-occupied housing debt to income is also high at 109. So what's happened over the last couple of years is that the incomes have been flat, but we're still borrowing more relative to incomes than previously, right? And the question is that sustainable? And, can you continue to do it? Because, of course, the stimulus approach that's now being used to try and actually fire up the housing market again implies more households getting more debt. Yes. But my theory is we're getting to the point where effectively we're reaching a ceiling where households cannot service more debt, even with the changes that APRA brought in, and we'll talk about that in a second. To my mind, this is a really important indicator, and relative to pretty much every other economy around the world, our debt is higher.
And it's one of those dichotomies where some other economists argue that, that is an asset. This makes the family wealthy and whatnot. So it's a good thing that they have this house behind them. Whereas other people are saying, well, just because you take out a huge mortgage and go into debt, that doesn't really mean that that's your asset.
Yeah, but the point there is that the wealth effect, on the way up means your house increases in value and therefore you feel a bit more wealthy. But it's dropped, 10, 15%. Sometimes a lot more. We're not seeing anything like any home price recovery at the moment. It might be stabilizing, but no real recovery. So there's no positive wealth effect in here at the moment. And you've got all the negative news around 2 rate cuts and the cost of living and unemployment and all those things. So we haven't yet really, I think, seen any indication that ahead we're going to see massive increases in home prices. My view is there will be a little bit of a recovery in some areas for some types of property, particularly houses close into the CBD. But if you look on the urban fringes, I suspect they're going to stay pretty low. And if you look at units, particularly those in the high-rise segment where we know we've got lots of issues now with poor quality construction, values there have dropped in some cases already 30%. So, a lot of wealth has gone away.
Yeah, and I think that's in one of the slides we've got coming up as well. Now, there's a lot going on in this debt-driven problem slide, Martin. It's a little bit small to see. So do you want to talk people through these 2 slides?
Yeah. So essentially, all this is the data from the Reserve Bank, and it's really just making the point that overall, the amount of credit lent in the system is going down, right? So the owner-occupied lending growth rates over the analysed basis is still 5.3%. So remember that inflation is, around just below 2%. Income growth, around 2%. But owner-occupied growth is more than double that. Yep. Investment lending is much lower, 0.5% annualized. And personal credit overall is going backwards. But the other point to make there is that business lending is also slowing as well. So we are seeing a lot of momentum easing out of the market. And we'll keep talking about this credit impulse, right? So as the credit impulse dies, home prices will fall, and also economic activity will fall. Now, the other point to make is on the other side there that we've got a tracker on the non-bank sector. Very interesting if you compare the non-bank sector with the main bank. So the non-bank owner-occupied growth is at 10% over the last year. And for the investment sector, it's nearly 6%. So you can see that a lot of the growth that is going on at the moment is in the non-bank sector, where they don't have the same controls in terms of capital and regulation supervision. So I'm afraid that those are signs, in my view, of more risk in the system ahead.
Yeah, absolutely, that risky behaviour. So new finance approvals still fairly weak, and I guess the good news is that first home buyers are the people that we'd loved to see being able to afford homes, and that is ticking up.
Yeah, so this is the data that came out yesterday from the ABS. So this is flow of new loans, and remember that this is before all the stimulus measures, right? Yeah. So effectively, what we saw there was the overall owner-occupied and investment loans are continuing to fall, but within the mix, you do have a little bit of an uptick in first home buyers. Not too surprising. Rates of coming down, and prices are coming down. But, reflect on the fact that this is before the 2 Reserve Bank rate cuts and the tax cuts and the change to the APRA floor limit, which ANZ interpreted as basically moving loans from 7.25% previously as a floor down to something like 5.5%. As a minimum. So that's quite a big change if they actually execute on that. And of course, there's a push for banks to lend more. And, various people in the government have actually been jawboning the banks, said, lend more, lend more, lend more. So, they're trying to drive the credit machine. But just remember that we've got higher and tighter household expenditure measure ratios now, and still half of loans are being used against an HEM benchmark when you assess expenses. Yep. And you've now got tighter focus on responsible lending. That hasn't gone away completely, and in fact, ASIC is still doing more on that. And the levels of confidence, as I showed in my earlier slide, is also relatively weak. So if you pull that together, the interesting question over the next 2 or 3 months will be, will we see this turn around? Will we see effectively the rate of flow of new loans begin to take up? And if that does tick up, does that then mean that the credit impulse goes positive? And if it does go positive, is that going to drive home prices? Those are all the questions we can't answer yet, but that's what we're watching.
I spoke to one of my friends who's at the coalface. He's a broker, and he was saying that he is going to have to employ more staff. He sees this as a lot more loans are going to come through, but at the same time, he was kind of shaking his head saying, this is dangerous. If interest rates ever creep above that 5.5% in the next 30 years for the life of the loan, if we get any sort of inflation or they return to historical norms, these people can't pay their mortgage.
Well, that's right. So the buffers are being reduced. In other words, households can perhaps borrow a little more because rates are really, really low. But as you say, what happens if rates go up? And of course, the other point there is a lot of the activity we're now seeing is a refinancing an existing loan to a lower interest rate, right? So frankly, if you've got a mortgage, shop around. You will almost certainly be able to get a cheaper loan unless you're in a higher loan to value ratio band or you've got other risks attached to your mortgage. So a lot of people are shopping for a lower loan, which will help them. But, that isn't actually new lending. That's effectively just moving the parcel from one bank to another bank, right? And so in a way, refinancing doesn't really help credit momentum, right? So you can have a lot of activity in refinancing and it doesn't actually change the ultimate amount of lending out there. The real interesting question will be, will more new people come in? Investors are still sitting on the sidelines saying, well, rentals are down, 4.5% down in Sydney, I think over the last year just reported. Costs of investment loans are still higher, so you won't get anything like the reduction in the floor rate for investment loans, I think. And what that means is that many people will not be coming in from the investment perspective. Foreign buyers are still sitting on the sidelines as well. I doubt they'll come back given everything else that's going on globally.
Yes.
And so it really comes back to the first-time buyers. How many first-time buyers will be persuaded to come into the market now at the point in the market where perhaps prices in the short term have bottomed, but as you said, the question is how risk averse are they going to be? and what happens if rates do move up later, or indeed if incomes continue to dive and costs continue to rise. It's a real problem. And the next slide really anchors this, right? So here's this really interesting point. If you look at dwelling prices and average full-time earnings, you can see how much it's changed from 1995, right? We've had dwelling prices go through the roof relative to earnings. So more households are committing more of their incomes to borrowing than ever before. And that is the fundamental point to understand here, right? Why? Because people have got much bigger debt, much bigger loans than they used to have. And I spoke to Steve Keen the other day, and basically Steve was saying that, debt is the critical issue. We're debted out. There's a limit to how much we can do. And I actually asked him the question in my show, which went up yesterday, and that's already quite popular. How much debt is too much? He said, we've probably got 3 times the amount of debt we should have in the system. So it's quite interesting just watching all of this play out.
Yeah, definitely some people starting to change their tune about their attitude towards debt. So the bank swaps and those rates are continuing to creep lower.
Yeah, so this is really interesting. So the BBSW is now 98.2 basis points off its peak previously and 62.9 basis points off its low from last year. This is a massive change in the funding of the banking system, right? And, I've had the theory for some time that it's the Reserve Bank's open market operations that are having some influence. Plus, of course, rates around the world are going down. This changes the funding of the banks dramatically. And that's why we're seeing now a lot of very cheap loans being offered, particularly fixed rate loans, because the BBSW has come way down. So the banks will have some wriggle room, but of course they've also got margin pressure and they've also got high level defaults than previously. They've got to try and manage all of this, but I would expect to see mortgage rates on offer from the banks to be ultra low based on what we're seeing.
Yeah, I'm not sure how transparent and up-to-date that data is, Martin, but I think that'll be a great video to cover as well about those open market operations in Australia compared to the US and so on.
Yeah, well, there is a recent article in the last RBA bulletin specifically describing their open market operations. And basically they talked in that about how they set their interest rate and how it flows through to their open market operations. So they influence the way that rates move up and move down. It's really very interesting. And that's one reason why I'm quite fascinated by the fact that the broad money measure is going up, right? That's how much money is in the system. That could be an indication of the Reserve Bank changing some of its settings to effectively help stimulate the economy. All below the waterline, all quite hidden, but I think it's quite a significant factor.
So for people at home, albeit this is maybe a type of QE or something unofficially starting.
Yeah, I have a theory that, for all the levers that we're pulling, you could say that, the tax breaks and the lower bounds from APRA, they're all forms of easing, right? They're all trying to stimulate the economy more. They're trying to get more people to borrow more. But it goes back to the fundamental question is, can we rely on debt as the engine to effectively turn our economy around? And, in the next 2 or 3 slides, I'll argue that it's unlikely that just using debt will be able to survive into a prosperous future. We need alternative strategies.
Yeah, this next slide is very interesting in terms of the units. This has really crept high in recent months again, hasn't it?
Yeah, this is CoreLogic data, and it's just making the point that when people are selling, they're often selling at a loss, particularly units. And I think that the unit sector of the market is really up for a big shake-up, not least because we've got all of these high-rise issues, not least because we've got an oversupply of units, another 200,000 coming on stream, newly built units coming on stream over the next year or two, and the fact that now many people are deciding perhaps they should get out. Investors particularly are looking to sell because the rental streams are actually being squeezed dramatically. And the other factor there is that, if you are actually a renter, you've got much more choice than ever before because effectively there's more supply of rental property. So put all that together. The other interesting thing, they made the point in their analysis that the average holding period for a property was 6 point something years. So this is not somebody buying and then flicking quickly, right? These are people who've had property for quite a long period of time, but have now decided it's the better time to sell. And I think they're probably thinking about selling into whatever rise there is because they don't necessarily think it's going to be sustainable. And units are really taking a lot of the pain here at the moment. So quite interesting. There are big changes and variations across the country, which I'm not going through now. But if you go and look at the CoreLogic data, you can see that it's not uniform. But I think this is a really important, if you like, leading indicator of what may be happening.
Yeah, that holding period of 6 years and that high percentage of people selling at a loss even after that average time is pretty shocking statistic.
Yeah. And remember that many people had 95% mortgages. Prices have dropped, in some cases 30%. So it's not surprising that, some people are actually struggling.
So households do not have money to spend, and a few different categories here. These are the sort of spillover effects, I guess, we look for households cutting back.
Yeah. So this is the ABS data, just making the point that retail spending is really flat, right? Really sluggish, and particularly things like, household expenditure on, one-off items like, a new fridge or whatever. That's all really, really low. They're still spending in some categories, but overall retail spending continues to grind along. And it goes back to what I said about what the RBA said. People with big mortgages have less money to spend, therefore they spend less at the shops. And the RBA has basically now realized that, in fact, the reason economic activity is so low is because we've got such a big debt overhang, particularly for owner-occupied borrowers.
Yeah, and that's also pretty evident in the auto sales numbers that we see as well lately.
Yeah, that's also true. Yes, you can look in other categories too, and they're having a pretty terrible time. And then the next slide is quite interesting because this is the good bit of news, right? So overall, the economy, if you look at the GDP and how it's working at the moment, businesses are not investing, household consumption is down, government spending on infrastructure projects is quite high, but the trade balance and particularly the commodities imports are going through the roof. We've actually got the biggest trade balance I think we've ever had, $5.75 billion in May. Yeah. And that's amazing. So that will help to support the overall GDP number for a period of time, right? But you've got to look below the waterline there. And the next slide is just the iron ore price, right? We've got a massively high iron ore price, although it dropped 5 or 6% because China has announced that they're going to start looking at why iron ore prices are so high. They're arguing that they're higher than they are naturally in the market. And now this was explained by the Vale disaster previously, which is why the Brazilian exports dropped, and that's why we picked up the slack. But now other production centres like Indonesia are now firing up because of this higher iron ore price. They can make money. Yeah. So we could well see the supply-demand equilibrium change. And if China, particularly China, comes off the boil in terms of its demand for iron ore at the time when there's higher supply, the iron ore price may well drop. If it does drop, then the one shining light in our economic story could be at risk.
Yeah, and I think that that number alone, with a decrease off the top of my head of around 20% in the iron ore price, would be enough to bring us back from surplus to deficit from memory.
Yeah, no, you're right. It's that big a deal. Yeah, so watch the iron ore price. It's one of my leading indicators, which I'm tracking. Fantastic. And then the final chart, which is the Bank for International Settlements, which is the bankers' bankers. I guess you could say it's the trade union for central banks, right? But they came out recently with a really interesting statement in their annual report, and they basically said, look, there's a global slowdown. It's deeper than expected. But what they went on to say was monetary policy, in other words, cutting interest rates, is not going to cut it. It's not going to have sufficient leverage to answer the call this time around. Monetary policy can no longer be the main engine of economic growth. Other policy drivers needs to kick in to ensure the global economy achieves sustained momentum. So what they're saying is, guys, you can't just do this with quantitative easing and cutting interest rates ever lower, right? You've got to think about infrastructure. You've got to think about innovation. You've got to think about other fiscal measures as well. And of course, that's something that's now has been echoed by the Reserve Bank here in Australia and elsewhere around the world too. So I think we could be coming to the end of monetary loosening, despite the fact that the Fed is likely to loosen in a few weeks' time, and other central banks around the world have cut rates and cut rates and cut rates. The BIS is saying you can't do it with just monetary policy. I think it's a really interesting statement, and it's the first time they've been so definitive on it, and I think this is highly relevant to the local economy here in Australia. I think the government needs to do more. There are other things they could do. Just because they want to protect their surplus, they may need to actually spend bigger to help support the economy through this, because I think the economy is still looking quite wobbly.
Yeah, I couldn't agree more with all of that. And lower interest rates hurt bank profits, and they're really reluctant to go below that zero bound. And if they go deeply negative, then there's the war on cash, Bitcoin and cryptocurrencies. That's going to hurt the banks, and they've got all these issues. And I think this is just going to be the most talked about topic in the macro sort of global environment for the next couple of years.
Well, you're right. So effectively, what is the alternative to, the central bankers just continuing to cut rates, and how far can they go? And, do you end up like Japan or whatever, right? There is no evidence yet that this works. It moves the problem down the track, but doesn't answer the problem. So we need some alternative thinking, I think. And, frankly, a lot of mainstream economists are still trying to get their head around this. But there is clearly a need for different thinking to be able to get us out of this current bind, because monetary policy won't cut it.
So tying this all together, Martin, we are expecting some relief in the Australian housing market, but bigger picture, we think that big ship that we talk about is pretty slow to turn around, and it's not just going to turn on a dime.
Yeah, I think there will be a little bit of good news over the next few months for housing. Won't be a big bounce back, but then I'm expecting it to fall away again because the debt burden is so high here. But I am looking out now for some alternative thinking in terms of other things that could be used as part of a strategy to take the economy towards a more sustainable growth path. Not just relying on debt doesn't make a lot of sense.
Fantastic. Thanks so much for joining us today, Martin, and we'll talk again soon.
Good to talk to you.
Thanks, guys.